You are now listening to The Big Trade with Peter Pham, enlightening conversations for maximum market returns.
I'm here with Simon Black. Why don't you introduce yourself to the audience?
Okay. Well, I'm ultimately an investor, an entrepreneur, and a longtime perpetual traveler, which basically means I have no fixed base or permanent home. I've been to over, I think probably now 116 countries on all 7 continents. And in any given year, I'll probably travel to 30 or 40 different countries. And the reason that I travel so much is because I like to put boots on the ground all over the world, meet with people, and actually see with my own eyes what's really going on and where the opportunities are. And I find that really no matter what's going on in the world, I mean, I think we have to be honest and say there's a lot of really crazy stuff happening in the world and in finance, and there's a lot of reasons to really be pessimistic. But I'm out there seeing opportunities on the ground firsthand, and I'm here to tell you there's a lot of really great things going on out there in the world, a lot of great opportunities, and a lot of reasons to be optimistic.
So what countries would you be the most optimistic about in terms of setting up a new life potentially if you're living in the developed world?
Well, that's one of the things that we talk about. I mean, we try and tell people, look, the world is changing. There's nothing that's coming to an end. This isn't some crazy doom and gloom scenario, but let's be honest. The path to prosperity isn't paved in conjuring trillions of dollars out of thin air or going into debt. Where are most of your listeners from?
America.
Okay, generally from the United States.
Yep.
Look, in the United States, about a couple of weeks ago, the U.S. government released essentially its financial report of the United States government. This is something that's published by the Government Accountability Office. This is publicly available data that is published by the U.S. government's own accounting office, basically, its own internal accountants. And they put together financial statements for the United States government. Just like financial statements for any business or bank, they have assets and liabilities. And so the Government Accountability Office, the GAO, adds up all the assets of the U.S. government, the highway system, every tank, every bullet, every, the president's jet and the national parks and the strategic oil reserve, and all those things add up all together. And then they subtract the liabilities, all the debt, all the different things, all the trade payables and all those different things that go into liabilities column, and you get essentially a net equity. It's the same thing as you and I. I mean, we might have assets and liabilities, our house and cash versus credit card debt and so forth. We have a net worth. The net worth of the U.S. government is negative $17.7 trillion. Which is worse than last year, which was minus $16.9 trillion. Now, this is assets minus liabilities. And, people often say, well, you can't, the U.S. government's in a lot of debt, but how do you value the highway system? And how do you value, all the military equipment? Well, the GAO does that. And so it shows that they're completely and totally insolvent. And if you add unfunded liabilities, which they count as $42 trillion in terms of the shortfall in Medicare and Social Security, you're talking almost $60 trillion in negative equity. That's not prosperous. And so what we try and encourage people to say is, look, if you have all of your eggs in one basket, if you live and work and invest and own real estate and structure your business and have all of your employees and all these things all in the same, it holds your capital and your savings and your retirement account and bank and so forth, all in the same place, and that place is a completely bankrupt and insolvent country, you're really taking on a lot of risk.
Now, we understand it fundamentally about the U.S. and its twin deficit situation. The question that I would have is, one of the special features of the U.S. is it functions as a world reserve currency, which gives it some unprecedented abilities. Now, as you know, that the U.S. dollar has been appreciating quite a bit. In fact, it's the largest position in our hedge fund. I'm not dogmatic about the position. I understand everything that you indicate. But how would you try to, because there's a lot of gold bugs, and I'm sure there's a lot of people that are speculating the hedges to all of the concerns that you discuss about. What is your comment to the ability for the U.S. and other central banks around the world to print their way out of this issue that they have. And clearly what we've seen is a deleveraging of the world economy. The financial service sector post 2008 has actually managed to deleverage up to 20% relative to the rest of the global economy, which is probably only 1 or 2%. So there's clearly is a major wealth divide that's happening between the rich and the poor. Oligarchs are playing a bigger role as they start to roll up the rest of the economy and start to implement additional regulations. But what do you think about the ability of central banks to, primarily the U.S. central bank, with its reserve currency status?
Well, I'll disagree with you on one point that you mentioned. You said that the U.S. dollar as the reserve currency is in an unprecedented position. I'll disagree with that. There have been reserve currencies in the world that have dominated global trade for over 1,000 years.
Correct.
You can go back to the Byzantine solidus and the Venetian gold ducat and all these different reserve currencies that existed. You could find Byzantine solidus gold coins as far off as the Orient.
Right.
They were used in trade widely all over the world. And when the Byzantine government got into serious financial difficulty, they did exactly what every government does when they get into financial difficulty. They started debasing their currency. Mm-hmm. The U.S. government's doing the same thing. The British did the same thing with the British pound. I mean, this is not unprecedented. This is something that every government does, and essentially, currencies are really all about confidence. Reserve currencies are used widely throughout the world when people have confidence in the reserve currency. Where people start to lose confidence in the reserve currency, they start seeking alternatives. That's exactly what's happening right now. We're seeing a large worldwide push to move away from the dollar as the reserve currency. There's very clear indications of this happening. The Chinese right now are setting up essentially two banks to compete with as sort of global, multilateral development banks. Most famously is the Asian Development Infrastructure Bank that just the other day, the United Kingdom has decided that they want to be a founding member of China's Asian Development Infrastructure Bank. Mm-hmm. So you've got now basically the number one ally of the United States government running into the arms of the Chinese to sign up to join them in this essentially new China-dominated financial system that's away from the U.S. dollar-dominated financial system. Mm-hmm. Every U.S. ally, the French, the Canadians, everybody has been setting themselves up to essentially deal with the Chinese, to deal with the renminbi, and move away from the dollar. So this is something that, again, it happens from time to time. There's always been in history dominant superpowers and dominant reserve currencies, and those change from time to time. Every dominant superpower that issues the dominant reserve currency in the world throughout history has always assumed that they can do whatever they want to do. The Byzantines thought that they could continue to debase the currency and the rest of the world would just deal with it. And they did for a while, and then they stopped, and they found another alternative. The U.S. government thinks that they can print as much money as they want to, and the rest of the world will just deal with it. And the rest of the world has been dealing with it for some time, but now, they're actively seeking alternatives. And everybody else seems to get it except for the U.S. government.
Simon, what do you think about because this is actually what's happening is that the rest of the majors are actually declining at a greater pace relative to the U.S. dollar. Now, it's basically effectively a race to the bottom, which isn't a good thing. But in terms of that comment that there's a growing need to develop some kind of alternative to the U.S. as a reserve currency. By the way, what I meant was unprecedented was more about not that that's never happened before, but just kind of like the current environment with quantitative easing, these factors into account. What do you think about, because one of our largest positions actually is also in renminbi denominated debt, dim sum bonds actually. But you can clearly see the actual underperformance relative to the US dollar at this current juncture. Now, one could be very skeptical, right? I'll take a look at the IMF, which is also actively developing, alternative currencies. But if you take a look at the reserves that the IMF have, it's about $750 billion. Now, if there was truly to be a financial crisis that would occur and there was going to be an additional transition along the way and then, then would lead to an alternative reserve currency or alternative competing currencies, I don't know if any of them, including the ADP, are financially, fiscally capable to absorb this magnitude of leverage that could be happening around the world right now. That's kind of like one of my concerns. I've had a chance to speak to a gentleman named Porter Stansberry. I asked him also, what do you think? Do you think that the U.S. would lose its reserve currency status? And he pretty much confidently indicated to me that he doesn't think that would be the case. We also know Jim Rickards is a big proponent of the IMF. I think friend of yours, right? He talks about that a lot as well. So I'm trying to assess the realpolitik of what you're saying versus what I know about the financial situations of these, say, multinational currencies versus what we currently have, which is the US dollar, which is still outperforming all the other alternative currencies as they all race to the bottom. What are your comments or thoughts about that?
Well, I guess take one at a time. I think somebody like in Jim's position, you remember in Jim's book and the presentation that he gives frequently and the presentation that he actually gave at an event that we held in Chile, I guess back in 2013, Jim outlined essentially 4 scenarios because he has a view that, essentially, his new book, When Money Dies, the Death of Money, that there's essentially 4 different types of scenarios that might end up being the case. We've had, if you look in the past, we had a housing bubble, and the housing bubble became a banking bubble, and the banking bubble became a bubble in government debt, and now what we have is that sort of trickled up the food chain to where we have a bubble in central banks now. There's not really anywhere else you can go. Governments have basically imploded and have started their defaults and are in terminal crisis and so forth. We see this in Europe. We've seen this in Japan, where now the bubble has matriculated up the chain to central banks. And now we've got central banks that are basically insolvent. The Federal Reserve, which is the issuer of the United States dollar, is on a mark-to-market basis now insolvent. Even on if you just look at their book value and you don't mark their assets to market, the capitalization level of the Federal Reserve, it's essentially net equity or net capital as a percentage of assets, is about 1.26%. And it declines just about every week when they release the H41 report every Thursday. So where else do you go when central banks are basically insolvent? Governments are insolvent. Now that insolvency has matriculated up to the central bank level, well, you have to go to sort of a supranational central bank level. That's really the IMF. As you point out, $750 billion, is what's in the coffer. But when you're talking about literally trillions and trillions on central bank balance sheets, 750 billion is really just a drop in the bucket.
Right.
Jim's sort of assessment was that there could be a scenario in which the reserve becomes the SDR, or there might be an option where it gets backed by gold in some capacity, 10% backed by gold, something like that. So Jim has a number of scenarios there, which I don't want to speak for Jim, but having spent a lot of time with him and seeing his presentations and so forth, I don't think that Jim is necessarily suggesting that the government can essentially print as much money as it want to, it will, and the dollar will forever remain the reserve currency. I think he outlined some different scenarios in which that's absolutely not the case. It was kind of interesting. I was had the opportunity to speak to Niall Ferguson, who's a professor of economic history at Harvard, when I was in Curacao last week. And I asked him the same question. I said, look, you're probably one of the most qualified people to answer this question. You know that reserve currencies do tend to change from time to time. And so the dollar is in this position where it's so highly leveraged that the government is insolvent, the pension funds are insolvent, the central bank is insolvent. The world is rapidly moving to, setting up an alternative financial system that doesn't involve the dollar. What's your view here? And he had quite a bit to say about that. One of the things that really stuck with me was he said, that I'm concerned that the world might, I'm paraphrasing, but basically I'm concerned the world might actually get what it's wishing for. Meaning, do you really want the Chinese to be, running the global financial system?
Right.
And that was a bit of an ominous tone to that kind of thought. But I mean, ultimately, the way I look at it is there are not really any good options out there, and I think it starts with the premise of the financial system as it exists today, which is we have unelected central bankers that have been awarded totalitarian control over the money supply. Mm-hmm. In controlling the money supply, they're essentially controlling the price of money, ergo the interest rates. And if you control the price of money, then you essentially control the price of everything. And we see this is that as interest rates, the price of money rises and falls, it affects the price of everything from, share prices on stock markets and bond prices and what people, what governments and individuals and businesses pay for debt, to commodity prices and oil prices and so forth, which in turn affect the price of global trade and retail consumer prices and so forth, agricultural commodities. All these things are affected. And there's so many, there's just hundreds of millions, billions of moving parts in complex economies. And there are just, again, a handful of bureaucrats who supposedly have their hands on all the levers, trying to pull all the levers and push all the buttons in the right order and make sure that nothing goes wrong. And that's a lot of responsibility to place on the shoulders of a couple of people, and we just sort of trust them to get it right.
Right.
And what's amazing is that, the Wall Street Journal just released this poll to show that 70% of respondents had no earthly idea who Janet Yellen is, who was arguably the most powerful person in finance, who is certainly the most powerful person in the U.S. dollarized financial system. And 70% of Americans have no idea who she is. They know who some, reality starlet is, but the person who essentially controls the value of their savings, they don't have a clue who that person is. And that's, to me, ultimately the kind of the failure in the system, which means there are no good options out there when you're left with, essentially a government and a reserve currency that you can't trust versus a government and reserve currency that are completely insolvent. There's no good option there. That's, I think, a fundamental failure in the system itself, and not even necessarily any single government or central bank.
It sounds like to me that what you effectively have is basically the privatization of profits and the socialization of risk. And obviously, you're going from the private sector into, central banks, and it does generally feel as if it could then go to some kind of like multinational global bank to some extent. But like I indicated to you, is that it was a very interesting thesis that Rickards has, and I'd like to see more about where he's going with that, because if you take a look at the IMF, the actual board of directors composition, the U.S. is the one that has basically the majority vote. I think they got the veto vote for the IMF. That's first and foremost. We also then talked about the capital structure of that international bank. So if you're going to discuss about the capital structure of the Federal Reserve, which is very warranted, we then need to then do that same magnitude of research that you've done on the capital structure of the IMF, for example, and the Asian Development Bank, for example. That would be another suggestion. The next point is even the composition of the IMF's currency. If you take a look at its actual weighting, it actually weighs more towards, once again, the US dollar. The interesting thing is that that currency has actually depreciated relative to the US dollar in this juncture. I don't know if anyone in capital markets has thought about the implications of that and what that means. Either that means I would assume in an I guess kind of like pessimistic world that you would want to see all the currencies depreciate relative to the IMF's currency, special drawing rights currency.
That's right. Special drawing rights.
Yeah. But in that case, it really hasn't. I've actually taken a look, Simon, into like the daily price activity of that. So all worthwhile considering. And I think the existence of entities like FINRA and FATCA are really driving your point home, which is basically the ability of individuals and private sector to start to diversify internationally. Though through FINRA and FATCA, it becomes ever so more difficult for an American to do so. Whereas the government, through these international banks, are able to internationalize, if you notice. So it seems as if all the benefits, the true benefits of what you're talking about, is actually more applicable to the oligarchs than it is even to the individual. And I think what you're doing is a very good service, which is basically trying to help people get the proper kind of diversification to hedge risk. But the governments are making it that much more difficult to do so.
Sure. I agree with you entirely. And I think part of the issue here isn't even the level of risk that's out there in the system, but I think even the perception of risk that's out there in the financial system. There's almost perhaps it's a situation where people understand that there's risk, but because there's so much capital out there that people are willing to go out and pay negative yields, guaranteeing themselves to lose money. They're willing to go out and deposit funds in a bank where interest rates are negative and so forth. And so that's really what concerns me, is not only the level of risk that's out there, but how willing people are to accept the risks that are out there. And all this, to me, the insolvency in the central banks, the insolvency of governments, particularly in the West, the massive level of risk out there in the system, the willingness of people to go out and still invest in the system despite all the risks, all that suggests to me that there's something seriously wrong with the entire system. And again, if we go back and sort of look to history and take a really big picture view of the world, we can see that the financial system does change from time to time.
Right.
Periodically throughout history, there's always been major resets in the financial system. They've gone from one to another, and I believe that we're in the early stages of that, where we're coming to a time where nothing makes sense anymore, and down is up and up is down, and negative yields, and savers are now subsidizing borrowers instead of the other way around. None of this makes any sense whatsoever. They've completely broken the system. And that might work a little bit fine for a while, so long as everybody else is doing it. Maybe people have some expectations that it's eventually going to be okay and so forth. But you look at the trends, and central banks become more insolvent every month, and governments become more insolvent every month, and interest rates get even lower. And Draghi's now now it's going to be over 1 trillion euros, and now we're going to ratchet interest rates down even more into negative territory, and so on and so forth. And now there's another government shutdown looming, and so forth. And none of this is moving in the right direction. And so there's a certain point where, again, you brought up Jim Rickard several times. Jim has a really great point where he talks about, he's standing there in a room, and he was in this event of ours in Chile, about 550 people that we had in attendance. And he said, if one of you gets up and just bolts out of the room, nobody's really going to notice. 5 or 10 go, then maybe those 10 people that bolt out of the room, one person notices and follows along, and so forth. There's a certain critical mass where if 50, 100, 150 people suddenly get up and head towards the door, that's going to be the tipping point where suddenly almost everybody else gets up and heads towards the door.
The unfortunate thing, though, Simon, is that it feels as if not that many people are getting to the door. And as a pragmatic investor, and a very objective investor, you still, as long as the musical chairs game is still going on, and as long as you're not the last man standing, it's hard to take the counter move, especially when objectively price, for example, is equity markets are all-time highs, right? As the debt situation, which is not really a reflection on stock markets, by the way. I think we need to make that clear to the audience, is that the current fundamentals of the central bank and economies are no reflection on equity markets, although quantitative easing has allowed equity markets to basically make new all-time highs. I would caution people that are listening to this is just to completely close their portfolios off to some extent while, these gains are being made. And if you compare, say 30% 2 years ago on the S&P 500, 12, 13% on the S&P 500 last year, it's hard not to kind of if this is what the world is doing, then you still need to have a portion of your portfolio to benefit from that. And if equities is a concern, what we've done in our portfolio is that we have a big position in US dollars. Now, you don't even have to like US dollars, but US dollars is considered much more liquid, say, for example, than listed equities, which kind of reflect the same thing, but at least you have some layers. Whereas the typical guy that would be listening to you might be running out, that one guy that's running out, he's probably going out to buy gold. And the unfortunate thing is the underperformance of gold relative to all of this. So you kind of have to, give those central bankers a pat on the back on their way to manipulate the economy. And it becomes very difficult for an individual to go against that many institutions, especially when price is clearly not indicating all the concerns that we have about. Now, it does happen on some times and instances, but we have to be very cognizant of when that's happening and then being able to capture that trend. So what you're talking about is the fundamentals. And what we talk about a lot, Simon, is about the bifurcation between price and valuation. Now, you have this fantastic thesis about what the true valuation is of currencies and equities to some extent. And what we're saying is that the audience should also take into consideration price, because what happens is you can become dogmatic either way. You could be uber bearish. A gentleman like Mark Faber, I'm sure you talked to him, he's almost a perma bear. And if you take a look at his record for being a perma bear, it's not going to look so spectacular, despite him maybe fundamentally being correct. So, but then you might have like a perma bull, and there are going to be instances when markets are going to go down. So I just would want to just caution people about that. Is the fundamentals are very sound, and one day your thesis is going to be proven without a shadow of a doubt correct. When that's going to happen, we don't know. So the audience needs to prepare for that. But the true indication is price. Even banks and, all the hedge funds have done a very good job in controlling volatility, which is what people would consider as a risk indicator. So I think you need to take all those factors into consideration as well.
Well, I appreciate all the points. Look, my view is that's the part that I find very concerning. Again, is that perception of risk. There's several different types of risk, and I think if we fundamentally look within our human nature, we have let's say the fear of loss, which is a huge driver. Obviously, that's what in many cases risk perception is all about. Am I going to lose when I make this investment? But we're also seeing right now an even greater fear, and that's the fear of missing out. Mm-hmm. And what we're seeing right now is that the fear of missing out is far greater than the fear of loss. Mm. This, to me, reflects that we are in classic bubble territory. And I agree the fundamentals and so forth of the thesis are very sound. Nobody has a crystal ball. I would encourage people, I don't encourage anybody to go out and sell everything and put 100% of their assets in gold or anything like that. That's sort of the thing, is that a view that the financial system is over leveraged and that banks are insolvent and governments are insolvent and so forth somehow seems to suggest that this is conflated with a notion that you should be 100% in gold or something like that. And I don't necessarily see that to be the case at all. I'm not necessarily a gold bull myself. I own some gold, but it's not necessarily some huge portion of my own personal savings or portfolio. I think the best description for gold is really a conscious decision to not own, paper currency, to not be a paper bull. Right. But more importantly, I would just encourage people to go back to Benjamin Graham and find the margin of safety. If the assets that you're invested in are at all-time highs, there's very little margin of safety. And I would encourage people, if you're looking for something, we all have you have to do something with our money. If we put it in markets, we're buying it at all-time highs, there's very little margin of safety. If we buy bonds, we're loaning money to bankrupt governments at negative yields. This is crazy. If we hold it in a bank, we're essentially loaning money to a bank, which, by the way, is poorly capitalized and highly illiquid and is paying us rates that are far below the rate of inflation on a tax-adjusted, inflation-adjusted basis, holding money in a bank guarantees that you're going to lose money. So when everything that you're doing is risky and or guarantees that you're going to lose money, what is somebody supposed to do? I would encourage folks to go out and find the areas where there are still actually margins of safety. And that might actually require people go out and do things that are a little bit outside the mainstream. When all the mainstream options, again, are inherently risky and or guarantee that you're going to lose money, I would encourage people to listen to that little voice where the fear of loss might actually need to trump the fear of missing out, and find those investments where there are margins of safety. And I think there are plenty that are still out there for people that are willing to look.
Could you give maybe some examples? You don't have to go into much detail.
No, I mean, it's not a popular thing to say, but for depending on who you're talking to. But I mean, there are definitely different sectors. I mean, if you're somebody that's into equities, there are a lot of different sectors out there in different areas of the world where you can still buy a lot of value, and there are substantial margins of safety. Junior mining sector is one example where we find that there are still a lot of companies out there that are trading for less than the value of cash they have in the bank, and in some cases are even profitable. You're talking about a profitable company that is trading for less than the cash that it has in the bank. If I have to choose between buying a company for less than the cash it has in the bank and is cash flow positive versus buying in at some company that's trading at an all-time high and whatever, Netflix that's 77 times earnings, right. I'm going to go with a company that's trading for less than the cash it has in the bank, because there's a much greater margin of safety there. And if all it does is just return to the level of cash it has in the bank, then I'm probably going to double my money. If it falls, then there's significant value there as a margin of safety. I think that's a safer bet. There are other markets in the world. I'm down here right now talking to you in Chile. The Chilean stock market is heavily undervalued. The Russian stock market is extraordinarily undervalued. You can buy entire companies for far less than their book value that are paying 7, 8, 10%, dividend yields and so forth. There's risk in everything that we do, and the problem is that I think that the system has essentially squashed any notion of risk versus reward. And now it's essentially all risk and very little reward. And yet that little voice inside says, don't miss out, don't miss out. And the fear of missing out has completely trumped the fear of loss. I would, again, just encourage people to look at some of these different areas where there's still opportunities to find that margin of safety. And you can still, it sort of writes people back onto the risk versus reward curve. You can actually generate decent rates of return without having to take on extraordinary amounts of risk. And again, those opportunities are out there. If you're into equities, there are equity opportunities. If you're into real estate, there are a lot of really great property opportunities out there. I mean, I look at this stuff all the time as I travel around the world. Again, right. One of the reasons why I travel so much. And I look at places, I find places where, and we're into agricultural property right now. We're buying thousands of acres of productive agricultural property. It's something that generates significant cash flow, being able to generate 20, 30, 40% returns, and being able to backstop that with real assets.
In which countries or areas?
In South America.
Okay.
South America. Some of the best property deals in the world is still in South America. We're seeing properties in, Colombia, Ecuador, Peru, Chile, and so forth, where you can buy. I mean, even as just an individual, being able to spend $75,000 on a property where there's a beautiful, 2,000 square foot house. That you wouldn't be able to build that for less than $175,000, and it comes with 12 acres of highly productive land, and all that for $75,000. I mean, you're talking about essentially getting a $150,000 house for $75,000 and 11 acres for free.
Are these considered long-term leases, or are they outright ownership for a foreigner?
Outright ownership. Outright ownership. I only buy in places where I can actually own title to the land. So again, it's when I look at a situation like that, I think, okay, I'm getting a $150,000 house for $75,000. I mean, a house that would cost me $150,000 to build for $75,000 and 11 acres for free. It's hard to get hurt. It's hard to get hurt. That's a big margin of safety. And that's what I'm saying. I would encourage people, instead of saying just like, oh, let's just throw money into the market and, because we don't want to miss out on, maybe the S&P runs up another 20%. I would just tell people, look, there are other opportunities that are out there that aren't in the mainstream. You're not going to turn on CNBC and listen to Jim Cramer telling you about, whatever, where there are real margins of safety out there. But there are places out there where you can invest. If you're into real estate, there are options in real estate. If you're into equities, there are options in equities. There are even options with bonds. There's some, I was just out in Singapore. There are some companies that basically de facto owned by the government of Singapore, which is a government with zero net debt, awash with cash, has some of the largest sovereign wealth funds in the world. These companies are basically guaranteed by the Singapore government, and they're paying 5% in U.S. dollars. If I have to choose between that or paying, essentially negative interest rates and certainly negative inflation adjusted interest rates, I'm going to go with 5%, instead. There are well-capitalized banks in the world. You can hold your money at some very large bank in the United States and get 1/100th of 1%. And these are banks that are poorly capitalized and highly illiquid. Or you can hold money in a bank overseas that's willing to pay you 5, 6, 7% interest in U.S. dollars. It's actually very well capitalized and extremely liquid and safe and stable, and in a jurisdiction that's never had a banking failure. And so again, for people that are willing to go out there and look, there are better options that are just outside of the mainstream with whatever you want to do. Even if it's just holding cash, there are better options out there.
Some feedback regarding that is that number one is we have purchased commodities fund, actually, which focuses on producing covered calls to generate any kind of downside risk that pays a yield of, say, 15% per annum. The issue is obviously through the whole mining sector overall is the significant pullback and in that market. And hopefully what investors are able to do is generate some kind of return that could be paid back in terms of dividends. But unfortunately, the capital outlay for many mining companies is extremely high. I had a chance to speak to Rick Rule, which is very renowned commodities investor, and he actually focuses using his funds to act almost like an investment banker to many of the mining companies. He'll structure a deal. Maybe it could be like mezzanine finance, some kind of unique credit structure that allows him almost like the best kinds of deals within the mining space. The issue is that there are a few good, like, say, royalty companies that are able to act as an investment banker, gives the individual listener some exposure to them, but they're still going to be a victim to various different cycles in the market. That's some general thoughts on the mining space. In terms of the agricultural space, absolutely fantastic. The key issue is in terms of real estate is sometimes you do have to think of it as if it's almost a private equity investment, which means especially in frontier markets, it can become extremely ambiguous. I spend a lot of time in Asia, Vietnam, Singapore as well, in Hong Kong, and I deal with a lot of funds that try to take these private equity investments. They try to get a valuation or an appraisal on these assets, and sometimes they can influence the value. It could be even a big four auditing firm that they could actually effectively pay out to value these assets favorably. So it's just that's one caveat in terms of frontier and emerging market real estate, is that you got to really be willing to get your hands wet and roll up your sleeves when assessing stuff like that. The one thing I would say about markets overall, like, if someone was to buy like a broad index or something, is that there is an element of volatility that is taken out of the equation. What I mean is an element of risk that's taken out of the equation, which is having to be able to forecast the earnings of many of these companies. Now, many newsletter subscriptions are able to write great copy in terms of describing how fantastic of an opportunity it is. One of their weaknesses I've observed is their ability to help you address these moments of volatility, as in, like, pre-earnings, post-earnings, assessing what's really happening to the company. Now, once again, the fundamentals can be absolutely fantastic. It's actually the earnings calls that give a kind kind of like a forecast to the fundamentals to some extent and have a major impact on price. Whereas an investor that buys a particular index because they know, yeah, QE's going like crazy until things change, I still got the exposure that I need without having to worry about, is XYZ manager a crook? And that's one of the concerns about the companies. So that concept of margin and safety, it's all about perspective and doing within what you are actually capable of. And hopefully you have the right kinds of advisors that understand all of these dynamics when trying to find the best opportunity costs, especially around the world for you. I would argue that there's very few markets in the world that are as attractive as US from a corporate compliance perspective. I'm not saying they're perfect, right? But having spent a lot of time in emerging markets, frontier markets, you will see literally crime being committed from a moral hazard perspective, from a malinvestment perspective, from even a linguistics issue perspective, right? Trying to understand what the local is saying about a particular asset, and are they providing you that information because you're an outsider, a foreign, a foreigner that doesn't have the insight of the intricacies of that local market. So I think all of those are very interesting perspectives. But at the end of the day, it sounds like, Simon, what you're saying, and I've had a chance to read that book on anti-fragility, is acting like a hedge fund can be a very anti-fragile and robust strategy even for an individual. And I think that's the key takeaway, is you got to be thinking outside the box. You got to think what hedges yourself, keeps you liquid, also keeps you safe, maybe in private equity or illiquid investments when the time is right. But then it becomes ever so more difficult and cumbersome to balance all those opportunity costs.
Sounds great.
Let's talk about maybe a few more questions. You run a lot of parallels between like previous empires and like say the United States. What are the similar parallels between like say the Roman Empire and the United States? Richard Mayberry, which I had a chance to discuss with, he talks about the debasement of the currency, the moral hazard. Love to get your take.
Well, I mean, there are a ton of similarities. I mean, not only I think between the Roman Empire is one that's often used. I think there are a ton of other examples out there. I think if you look at everything from the decline and fall of the Roman Empire to even the decline and fall of the French Bourbon monarchy, the Habsburg Empire, or even the Soviet Union, what you start seeing is debasement of the currency, overregulation, expansion of the state, drastic overuse of the military, waging wars of folly and military campaigns, completely and wholly unnecessary military campaigns around the world, unsustainable finances and trade deficits and so forth. These are the things that are common, not only to between Rome and the United States, but essentially a lot of former empires that have come and gone, or at least entered into serious decline since their height. Okay.
And I know you talk about the 6 pillars of self-reliance. So we talk about state and we talk about individual liberty or sovereignty. Tell us a little bit about the 6 pillars of self-reliance.
Well, the entire idea behind it is that I think that it's clear that most people are heavily dependent on government, on all the different systems out there, on the financial system, on their banks and brokers and so forth. And the idea is to really, again, in this time when everything is just up is down and down is up, and good news is bad and bad news is good, and very little actually makes sense anymore. It becomes increasingly important to actually go out and re-embrace being the individual and being more self-reliant instead of being so dependent on all the various systems that are out there. And I think with respect to your audience in this show and an investment, again, I think that fundamentally means really thinking outside of the mainstream investment options, thinking outside of, really U.S. stocks trading at all-time highs, U.S. government bonds as the, quote, risk-free rate, and U.S. mutual funds, which are in many cases just the same guys that parked people into risky assets back in 2008.
Right.
And I think there's an entire world of opportunity out there, and we can sort of nitpick every one of them and find flaws and so forth. And there's really nothing out there that's perfect. I would just encourage people to go back and look at the risk versus reward curve and try and find the right place for them, as opposed to where we are in conventional finance, which is very high risk and very little reward in return. Go back to that fear of loss as opposed to the fear of missing out.
Okay, excellent. So it's been a great conversation with you, Simon. I'd like to end this off by playing a word association game. That way we touch some topics that we haven't touched on already, just to get your initial thoughts or reaction on that. So let me start off by saying the first one, which is taxes.
Pain.
Sovereignty.
Freedom.
Switzerland.
Old.
National debt.
Huge.
Offshore banking.
Safe.
Investments.
Risky.
This conversation.
45 minutes.
Thank you. Thanks, Simon. It was great talking to you.
Okay, I really appreciated it.
We hope you enjoyed this mastermind session. If you'd like to contact Peter Pham or Phoenix Capital, please email info@phx-cap.com.